Right now, lots across this country are filling up with SUVs that are barely a year old, not trade-ins, not lease returns, vehicles people fought to get approved for, drove off the lot proud of, and are now desperate to walk away from. You've probably seen the headline, "Millions of Americans are returning their new SUVs in 2026. Here's the part nobody's telling you. You can't just return a car like a sweater. Dealerships don't work that way. What's actually happening is worse. It's repossession. It's forced trade-ins at a loss. It's owners drowning in payments for features that don't even work half the time. By the end of this video, you'll know exactly what's driving this wave of regret. The subscription fees hiding behind your dashboard, the sensors that cost more than your engine, and the one category of SUV that buyers are fleeing faster than anything else on the market. Stick around, because number 5 on this list might be sitting in your own driveway right now. The repossession wave nobody wants to call by its real name. Let's start with the truth behind the headline, because it matters. Nobody is walking into a dealership handing back their keys and getting a refund. That's not how car buying works in America. What's actually happening is quieter and in a lot of ways more brutal. Buyers are defaulting, lenders are repossessing, and the vehicles piling up on auction lots are being spun into a viral narrative about returns because that story is easier to click on than the real one. Here's what most buyers expected walking into 2026. They expected their loan to feel like every other loan they'd had before. Manageable, predictable, something you budget around and move on with your life. What they got instead was a monthly payment that, for a lot of new SUVs, is now brushing up against record territory. Add in interest rates that climbed and never really came back down, and you've got a debt structure that was fragile from the day the paperwork got signed. This isn't a fringe problem. It's showing up in the numbers lenders track every quarter. Delinquencies climbing, more accounts slipping past 60 and 90 days late, more vehicles getting flagged for recovery, and the profile of who's defaulting has shifted. It's not just buyers with shaky credit anymore. It's people with steady jobs and decent credit scores who ran the math on a $700 or $800 monthly payment and discovered 6 months in that the math doesn't survive contact with real life. Rent going up, groceries going up, insurance going up, all while the SUV payment stays exactly the same. Here's the mechanism most people don't think about until it happens to them. When you stretch a loan to 72 or even 84 months to make the payment look survivable on paper, you're not solving the affordability problem. You're hiding it. You're pushing it further down the road while the vehicle depreciates faster than you're paying down the principal. That's how you end up owing $38,000 on an SUV that's worth $27,000. Upside down, underwater, whatever term you want to use. And when life throws a curveball, a layoff, a medical bill, a rate adjustment on a variable loan, there's no equity cushion to fall back on. The lender doesn't wait for that story to have a happy ending. They send a tow truck. The real world impact here isn't abstract. Picture a family in Ohio who financed a mid-size SUV 18 months ago. Payments were fine until the primary earner's hours got cut. They missed 1 payment, then 2. Then the calls started. By month 4 of being behind, the vehicle was gone, repossessed, auctioned for less than what was owed, and the family still owes the difference. That's not a return. That's a financial wound that follows people for years, showing up on credit reports, blocking future auto loans, sometimes blocking apartment applications. And this is the part that should genuinely worry you if you're shopping right now. Auction lots that used to be filled with older, higher mileage vehicles are increasingly stocked with SUVs that are barely a year or 2 old. Late model repos, vehicles that never should have ended up there this fast. Some auction houses are now reporting more late model repossessions rolling through their lanes than they've seen in years. Vehicles with the new car smell barely gone, sitting next to trucks twice their age. That's not a normal market cycle. That's a signal that the loan terms being pushed onto buyers in 2026 were built on assumptions that a lot of American households simply couldn't sustain. There's another layer to this that rarely makes it into the headlines. Dealers and lenders both have an incentive to approve loans that shouldn't get approved. The dealer gets paid the moment the deal closes, whether or not the buyer can actually sustain the payment 3 years down the road. The lender books the loan as an asset, bundles a slice of the risk off to investors, and moves on to the next approval. Nobody in that chain is financially punished for approving a loan that fails in year 2. The buyer absorbs all of that risk alone, and by the time the first missed payment shows up, the people who structured the deal have already been paid. That's why so many of these situations follow the same script. A buyer gets approved for more truck or more SUV than their income realistically supports, because the monthly number gets stretched across a longer term until it fits. Add-ons get layered on at the finance desk: extended warranties, paint protection, gap insurance, each one nudging the payment a little higher while feeling small in the moment. None of it feels dangerous sitting in the finance office with a salesperson smiling across the desk. It feels dangerous 8 months later, staring at a bill that hasn't gone down and a bank account that has. The uncomfortable truth is this: the SUV isn't the problem. The engine's fine. The transmission's fine. The problem is a financing structure that made an unaffordable vehicle look affordable for exactly long enough to get a signature. And that's a pattern that shows up again and again once you start looking for it. And it's only the beginning of why 2026 has turned into the year of SUV regret, because even the people who kept their payments current are finding reasons to hate the vehicle sitting in their garage. And that brings us to something almost nobody saw coming when they signed the paperwork: the subscription fee hiding inside their own dashboard. The subscription trap hiding behind features you already paid for. Imagine buying a house and then getting a monthly bill just to use the fireplace that was already built into the living room. That's essentially what's happening to SUV owners across the country right now, and it's turning brand new buyers into some of the angriest people on the internet. Here's what buyers expect when they see heated seats, remote start, or advanced driver assist features listed on the window sticker. They expect those features to be theirs, paid for, included. That's how it's worked for decades. You pay for the trim level, you get the hardware, end of story. What's actually happening in 2026 is a quiet redefinition of ownership itself. The hardware is still there, bolted into the seats, wired into the ignition system, built into the sensor array, but activating it, actually using what's physically sitting in your vehicle, which increasingly requires an ongoing subscription. Think about that for a second. You didn't just buy a seat with a heating element in it. You bought a heating element that's been intentionally locked, waiting for a monthly fee to unlock functionality that was already manufactured, already installed, already paid for once at the time of purchase. Remote start, a feature that used to be a one-time dealer install for a couple $100s, is increasingly gated behind a subscription in a growing number of SUV lineups. Some driver assist packages follow the same model. The radar and cameras are there, but full functionality requires you to keep paying month after month or watch the feature quietly disable itself. The frustration here isn't just financial, it's psychological. There's a specific kind of anger that comes from realizing you've been charged twice for the same thing. Once at the dealership, and now again every single month for as long as you own the vehicle. Owners describe feeling like they're renting features from a company that already took their money. And unlike a Netflix subscription, you can cancel without consequence. Canceling one of these automotive subscriptions can mean losing functionality that affects comfort, convenience, and in some cases, safety systems you assumed were simply part of the car. Here's the real-world scenario playing out in driveways right now. A buyer in Texas finances a new SUV, sees heated and ventilated seats proudly listed on the sticker, and 6 months later gets an email notifying them that continued access requires enrollment in a monthly plan. They call the dealer, confused, assuming it's a mistake. It's not a mistake, it's the business model. The dealer shrugs and points them to the manufacturer's app. The manufacturer points back to the fine print buried in the purchase agreement. Fine print almost nobody reads in the excitement of driving a new SUV off the lot. Why is this happening? Because automakers have realized that hardware margins are thin, but recurring software revenue is not. Every SUV rolling off the line is now, in a very real sense, a subscription platform on wheels. The car itself is almost a loss leader for the monthly billing relationship that follows. And once you understand that's the strategy, you start to see why so many owners feel deceived. They didn't buy a vehicle, they bought a vehicle-shaped invitation to keep paying indefinitely. Stack enough of these subscriptions together: heated seats, remote start, driver assist, and some owners are now paying more per year to unlock features in their own SUV than they used to pay for their entire cell phone plan. The ownership impact goes beyond annoyance. It changes the entire value proposition of the SUV. That heated seat you're paying $15 or $20 a month to use over a 5-year ownership period, that's real money stacked on top of an already brutal loan down payment, and when it comes time to sell or trade in, a subscription-gated feature is worth exactly nothing to the next buyer unless they're willing to keep paying too. That's a resale problem hiding inside a comfort feature, and it's one more reason buyer's remorse is spreading so fast in 2026. There's a trust dimension here that goes deeper than the dollar amount. Buying a vehicle used to mean the transaction was finished the moment you drove off the lot. You owned it. Nobody could reach into your garage and switch something off. That's no longer true. These vehicles are connected, which means the manufacturer retains a kind of remote authority over what your own SUV is allowed to do, indefinitely, for as long as you own it. Miss a payment on the subscription or let it lapse without realizing it, and features can simply stop working, sometimes without much warning. Owners describe the unsettling feeling of a car that technically belongs to them but doesn't fully answer to them. And it's not just comfort features anymore. Some manufacturers have experimented with gating portions of performance and safety adjacent packages behind the same subscription model, which raises a much bigger question buyers are only now starting to ask out loud. If a feature can be remotely switched off for non-payment, was it ever really something you bought, or was it always something you were renting with extra steps? That question is exactly why so many owners describe this as the moment their trust in the brand broke. Not the first repair bill, not the first glitch, but the first email demanding a monthly fee for something they'd already paid for once. But subscriptions are just the financial insult. The technology itself is causing a different kind of damage, the kind that makes owners question whether their SUV can even be trusted to drive itself down the highway, and that's where things get genuinely unsettling. Ghost defects and the technology nobody can fully explain. There's a specific kind of fear that comes from a car braking on its own for no reason on an empty highway. Owners are living that fear right now, and it's happening often enough that it's earned its own nickname in owner forums: phantom braking. What buyers expect from modern driver assistance technology is simple: added safety, added confidence, a system that quietly watches the road and steps in only when it actually needs to. What's happening in a growing number of SUVs is something closer to a system that's guessing, and guessing wrong. Radar sensors and cameras misread shadows, overpasses, or debris on the shoulder as an imminent collision, and the vehicle slams the brakes at highway speed with zero warning. If there's a car behind you, that's not a glitch anymore. That's a rear-end collision waiting to happen. This isn't limited to one glitch either. The complexity packed into a modern SUV has exploded. Massive touch screens replacing physical buttons, layered menus for functions that used to be a single switch, driver assist systems stacked on top of parking sensors, stacked on top of lane keep assist, all of it running on software that gets pushed out in updates the same way a phone app does. And just like a phone app, sometimes those updates introduce new bugs instead of fixing old ones. Owners describe infotainment systems freezing mid-drive, backup cameras that randomly refuse to display, climate controls that vanish into a submenu because a software update changed the interface overnight. None of this used to exist when climate control was 3 physical dials. Now it's a possible point of failure buried in millions of lines of code. Some modern SUVs are now running on more lines of software code than early spacecrafts. And when it breaks, there's no mechanic who can just tighten a bolt and fix it. It's IT support for your commute. Here's a real-world example that captures the frustration perfectly. A driver in Michigan describes their SUV's lane keep assist yanking the wheel toward a lane divider that the camera misread in low sun glare. A split-second correction they had to fight against on a system that was supposed to be protecting them. Another owner describes a touchscreen that soft-locked entirely, taking the backup camera and climate controls down with it on a cold morning with kids in the car. These aren't isolated horror stories anymore. They're common enough that owners are trading in vehicles specifically because they no longer trust the technology sitting between them and the road. The main cause here is speed. Automakers are racing to pack in more sensors, more screens, more smart features because that's what sells on a showroom floor and what generates glowing spec sheet comparisons online. But rushing complex driver assist software to market means some of it reaches customers before it's been fully tested against the messy, unpredictable reality of actual American roads. Construction zones, faded lane markings, weird shadows, aggressive drivers cutting in at the last second. The lab doesn't look like the highway, and the gap between the two is where these ghost ghost defects live. The ownership impact is exactly what you'd expect. Anxiety behind the wheel of a vehicle that's supposed to reduce anxiety. Owners start second-guessing every unexpected beep, every flashing icon, every unexplained jolt. Some disable the assist features entirely, which defeats the purpose of paying extra for them in the first place. Others trade the vehicle in years ahead of schedule, eating a depreciation hit just to get back into something simpler, something they trust. And here's the emotional core of it. A vehicle is supposed to feel like control. You decide where you're going, and it takes you there. When the technology starts making decisions you didn't ask for at highway speed with your family in the car, that sense of control disappears. That fear is a huge part of why 2026's wave of SUV regret isn't just about money, it's about trust. And trust, once it's broken by a car that breaks on its own, doesn't come back with a software patch. There's also a diagnostic problem that makes all of this worse. When a traditional mechanical part fails, a belt, a hose, a bearing, a mechanic can usually see it, hear it, or test it directly. Software glitches don't leave the same kind of evidence. A phantom braking event that happened once on a Tuesday afternoon might not repeat itself during a service appointment on a Thursday, which means the dealer's diagnostic computer comes back clean, and the owner is sent home with a shrug and a suggestion to monitor it. That's an infuriating position to be in, knowing what you experienced, unable to prove it, and driving the same vehicle again the next day with the same nagging uncertainty in the back of your mind. Some owners have started keeping their own logs, timestamping every strange behavior, every unexplained warning light, every moment the vehicle did something they didn't ask it to do, just to build a paper trail in case they ever need it for a warranty claim or a lemon law case. That's not the ownership experience anyone signs up for when they buy a brand new SUV. It's closer to being your own quality control department for a product that was supposed to already be finished when it left the factory. Quick pause before we get into the part of this story that's hitting owners' wallets the hardest. If this is opening your eyes to what's actually happening in the new car market, hit subscribe. We dig into exactly what dealerships and automakers hope you never research. Now back to the list, because it's about to get more expensive. Out of warranty repair costs that are bankrupting owners. Here's a number that should stop you before you sign anything. A minor fender bender on a modern SUV can now cost thousands of dollars to fix, not because the metal is more damaged, but because of what's hiding behind it. What buyers expect from a small parking lot dent or a low speed bump is simple. A body shop estimate, a few $100s, maybe a claim on insurance if it's bad enough. That's what a fender bender used to mean. What's happening now is that even minor collisions are triggering repair bills that rival a used car's entire value, because today's SUVs pack radar units, cameras, and sensors directly into the bumpers, grills, and mirror housings, the exact panels most likely to get hit in everyday driving. Here's why. Every one of those sensors needs to be recalibrated after even a minor impact, and that recalibration isn't a simple reset. It often requires specialized equipment, a controlled environment, and a technician trained specifically on that manufacturer's system. A cracked windshield used to mean a $250 replacement. Now, if that windshield houses a forward-facing camera for lane keep assist and automatic braking, replacing it means glass, calibration, sometimes a dealer visit, and a bill that can run well past $1,000. A bumper that houses radar for adaptive cruise control isn't just a bumper anymore. It's a sensor housing, and repairing it wrong doesn't just look bad, it can disable safety systems the owner is relying on without even knowing it. Then there's headlights. LED and adaptive headlight assemblies, the kind that automatically adjust beam pattern for oncoming traffic, can cost several times what a traditional halogen headlight used to cost, sometimes running well over $1,000 per side once you include the electronics involved. Add both sides together on some models, and the headlights alone can cost more than a decent used Honda Civic. A fender bender that used to mean an afternoon at a body shop can now mean a bill that makes owners seriously question whether the vehicle is even worth fixing. And here's the number that really puts it in perspective. A single radar or camera sensor replacement, once you factor in the part and the calibration labor, can now cost more than an entire used engine did 20 years ago. This has a ripple effect that goes beyond the repair shop. Insurance companies aren't blind to any of this. They see the claims data. They see that the average repair cost per incident on tech-heavy SUVs has climbed sharply, and they price premiums accordingly. Owners who budgeted for a reasonable monthly insurance insurance cost are getting renewal notices with jumps that don't match anything they did wrong behind the wheel. Nobody got a ticket, nobody had an accident. The premium went up because the vehicle itself became more expensive to insure. Full stop. Picture an owner in Colorado who backs into a shopping cart corral, the kind of minor incident that used to be a non-event. The rear bumper houses a parking sensor array. The estimate comes back well over $2,000 once sensor recalibration is factored in. That owner is now facing a choice: pay out of pocket, file a claim, and watch their premium spike at renewal, or drive around with a disabled safety system and hope for the best. None of those options feel good, and all of them are becoming more common as this technology spreads across every trim level, not just the top of the line models. The main cause is straightforward once you see it. Automakers packed advanced technology into exactly the parts of the car most exposed to everyday minor damage: bumpers, mirrors, windshields, grills, because that's where sensors need a clear view of the road. It's a smart engineering choice and a brutal financial one for the owner who has to pay for it every time a shopping cart gets loose in a parking lot. The ownership impact is a kind of financial anxiety that didn't exist a decade ago. Owners are now afraid of routine parking lot mishaps in a way they never used to be, because the cost of a minor incident has completely detached from what minor used to mean. And when you combine that with insurance premiums climbing to match, you get owners who feel priced out of a vehicle they already own, trapped paying for coverage on a car that's becoming more expensive to insure every single year they keep it. It gets worse once the factory warranty runs out. While the vehicle is still covered, a lot of this sensor and electronics damage gets absorbed by the manufacturer, which keeps the true cost hidden from the owner's view. The moment that warranty clock runs out, often right around the same 36,000 to 60,000 mile window where a lot of these SUVs are just settling into daily use, every one of these repairs becomes the owner's problem at full retail labor rates, with parts that are proprietary enough that there's often no cheaper aftermarket alternative. That's the exact same warranty cliff playing out again, just wearing a different costume. The bumper sensor, the windshield camera, the adaptive headlight. None of it cares whether your coverage just expired. It just needs to be fixed, and the invoice doesn't negotiate. Shops that specialize in this kind of calibration work aren't on every corner either, which means owners in smaller markets sometimes have to drive their damaged vehicle a significant distance, wait longer for an appointment, and pay a premium simply because there's less local competition to keep prices in check. What used to be a same-day fix at the corner body shop has turned into a multi-day ordeal involving specialized technicians, calibration bays, and invoices that would have paid for an entire used car a decade ago. That financial squeeze is bad enough on gas and hybrid SUVs, but there's one category of vehicle where all of this, the cost, the depreciation, the broken promises, collides hardest, and it's the one automakers bet the most money on: the electric SUV owners who regret it most. Every regret we've covered so far, the payment, the subscription, the glitch, the repair bill, shows up hardest in one specific group of owners: the ones who bought electric. Not because the technology is fake, but because nowhere else in this story does buyer's remorse stack this high, this fast. Start with resale. An electric SUV or truck bought at a premium price 18 months ago is, in a lot of cases, worth dramatically less today than the owner expected when they signed. Sales data through 2026 shows a sharp year-over-year decline across several high-profile electric SUV and truck models, and softening demand does to resale value exactly what it always does. It guts it. Picture trading in a vehicle you paid full sticker for, only to hear a number that makes you physically wince. That's not a hypothetical. That's happening on trade-in desks across the country right now. Then there's towing, and this is where the regret turns personal. A buyer chooses an electric truck specifically because the spec sheet promised real capability. Hook up a trailer or a boat, and the advertised range doesn't just dip, it can collapse, sometimes cutting usable distance so severely that a weekend trip turns into a stressful hunt for a charger that can actually handle a truck and trailer combination. Buyers didn't sign up to plan road trips around charger uptime. They signed up to drive. Charging frustration compounds all of it. Cold weather alone can strip a meaningful chunk off the advertised range before you've even left the driveway. today, and a public charging network that's still catching up to demand means quick charge doesn't always mean quick. Owners describe circling a shopping center hunting for one working charger among 3 broken ones. A level of inconvenience nobody pictured while sitting in the showroom watching a slick product video, and insurance doesn't let up either. Electric SUVs and trucks carry some of the same sensor-heavy, expensive-to-repair components we already covered, layered on top of specialized battery coverage, which means premiums on these vehicles are climbing right alongside everything else the owner is already regretting. Put all of it together and you get the sharpest version of 2026's SUV regret. The repossession risk, the subscription fees, the glitchy tech, the brutal repair bills. Electric buyers are carrying every one of those, plus a depreciation curve that's collapsing faster than almost anything else on the road. It's not that electric technology failed, it's that the promise outran the experience, and the owners caught in that gap are the ones who feel it every single time they check their vehicle's trade-in value and wince. So here's the truth behind the headline. Nobody's mailing their SUV back like an Amazon return. What's actually happening is repossessions climbing, subscription fees turning owned features into rentals, unreliable technology eroding trust behind the wheel, repair costs that treat a fender bender like a financial emergency, and electric SUV and truck owners watching resale value, towing capability, and charging convenience collapse all at once. Every one of these threads leads back to the same place. Buyers who trusted the sticker price and the sales pitch and are now paying the difference between what they were promised and what they actually got. Now you know what's really behind the story everyone's talking about, and that puts you ahead of almost every other buyer walking onto a lot this year. If you're dealing with any of this right now, a payment that's crushing you, a subscription fee you didn't see coming, a repair bill that made your jaw drop, tell me in the comments. I read every one, and those stories are exactly what the next buyer needs to hear before they sign anything. If this channel gave you something useful today, hit subscribe, because next time we're going after the flip side of this story, the used car market, and exactly what's happening to prices right now while everyone else is distracted by the new car chaos. You don't want to miss that one.